Winter. I'm going to be taking you through the investments and insurance section of work. All right, so there's a couple of things that you need to take note of here. So I've got two questions up on the screen there. So the first one is, where should I invest my money? And the second one, how can I make my money work for me? All right, so with investments, it's all about using your extra money that you may have to earn further income or a profit for me. Okay, and this is the same for businesses. So you as an individual will have a situation like this, and as a business, you also have extra funds available. So you need to see how you can make that money work for you. Okay, so that's why we've got the two questions over there. Where should I invest my money? Okay, what would be the most appropriate place or institution to invest my money in? And how can I make my money work for me? All right, so you might be investing in property, you might be investing in a savings account, or you might be investing in a business that might be able to give you a greater return on your money. So we'll be discussing a couple of those terminologies a little bit later. All right, so let's have a look. Okay, the first thing, so what is an investment? If we look at a definition of what an investment is, the first is the use of surplus money now for future financial gain. All right, so the next one would be, what is the financial gain? It's a return on that investment. So let's say, for instance, you've got 1,000 Rand, okay, and you want to invest that. You want to make sure that you are receiving more than that 1,000 Rand in return. Future financial income. All right, so there might be a number of reasons as to why you want an income in the future. Maybe you want to retire and you need to have a monthly return or income at a later stage. And then future capital gain.
Mr. Edwards, maybe a good question to ask is, we've got two ways that they calculate your financial gain, and that's a future financial income and a future financial gain. Now, what's the difference between an income and a capital gain?
Okay, so an income is very much similar to the salary that you'd be getting on a monthly basis. Okay, whereas a capital gain would be the return on the investment that you made. Okay, and that can come in a large lump sum, and that can be on a property that you've invested in, and it's normally over a longer term. Okay, so you've invested in a property of, say, 2 million Rand, and then years down the line, you get a return of, maybe you sell the property for 2.5 million Rand.
Okay, so with other words, if I've got a property of 2 million Rand and I sell it for 2.5 million Rand, then my capital gain would be the 500,000 Rand. That was, of course, then the difference between the selling price and my purchase price is the capital.
That's correct.
Capital
That's
gain.
correct. Okay, and you see a couple of examples on the screen there of some of the types of investments that you can make. Obviously, there's a fixed property at the bottom there. There is a vehicle at the top right, which is maybe not the best investment because, as you should know by now, vehicles depreciate in value. So you might buy a vehicle at 400,000 Rand today, but in a year down the line, you've lost a certain percentage of that value. Okay, Dion, why would you say that the taxi, the yellow cab there, is slightly different?
That would be, that's quite an interesting one, where Mr. Edwards has just explained now that if we buy a vehicle, it depreciates in value. So with other words, I'm selling it for less than what I've bought it, so I've made a capital loss. But the moment that I buy a taxi, that is an investment. The reason is I use the taxi to get taxi fare, and that taxi fare is in the form of a financial income. And that is then, of course, a return on investment. I hope my reasoning is correct.
For sure, for sure. Okay, so anything that you invest in with the intention of getting a return on your money. Okay. Now, there's numerous different factors that you need to look at when considering what you're going to be investing in and how long you're going to be investing in. So you might be unsure as to what to invest in, and these are a couple of pointers that you need to take into account. Right, so let's start on the bottom left. the return on investment. So we'll be looking at that in a little bit more depth in a moment. What risk are you going to be taking on? Because in any investment, there's a portion of risk, okay? And there's a number of factors that come into play there. The investment term, how long are you willing to put your money away for? And your personal budget. How much money do you have available? Because remember, we said an investment is looking at the surplus money that you've got that you want to earn an income from. Okay, so what is your budget? Maybe you've only got 800 Rand available at the end of the month, or you've got 2,000 Rand available at the end of the month, and what are you going to do with that money? Then the next one is liquidity, which we'll get into a little bit later. Okay, it's a little bit of a complicated term, but once we've gone through it, it should make much more sense. So let's have a look. So firstly, return on investment. All right, so guys, you've got all the different bullets there, the points available to you. So we will just touch on one or two. The first one there refers to income from the investment, namely interest, dividends, increased capital growth on the original amount investment. So let's just go through interest first. Interest is the rate of return that you have received on your money. Okay, so if you go to the bank, or we'll discuss fixed deposits later, fixed deposit will give you an interest rate. So maybe you've invested the 100 Rand, for example, and they have given you 6% interest on that, meaning that you're going to get 6%, 6 Rand of that 100 Rand back. Okay, so that's interest. When we talk about dividends, okay, dividends is a slightly different terminology. It is a portion of profits. So now when we go into shares a little bit later, you will receive, if you invest in a public company, you will receive your share, and that means that at the end of the financial year, when the company receives a profit, you will get a portion of that profit, and that is called dividends. All right, and then increased capital growth. I'll refer to the example that we used earlier about fixed property. If you buy a house for 2 million and you get 500,000 Rand growth, you sell it for 2.5 million, you've gained that growth. Okay. Look at that image at the bottom there. You can see what we're trying to make of return on investment. You want to put money in, and slowly but surely you want your money to grow up until a point when you need that money. Okay, it might be you needing the money for studies, or longer term you're wanting it for retirement or pension. All right, okay, so that's return on investment. Okay, now we look at risk. All right, so risk, unfortunately, in many investments that you might want to put your money away, there is a risk involved, and that is looking at the portion of money that you put away. So if I put 1,000 Rand away, is that 1,000 Rand at risk? Okay, so some investments that we'll talk about later, there is a possibility that 1,000 Rand, you might not receive that entire capital 1,000 Rand back. Okay, but you might have the possibility of gaining more return. Okay, and there might be another investment such as a fixed deposit where your 1,000 Rand is guaranteed. Okay, so you will always receive at least that 1,000 Rand back. Okay, so let's look at the first bullet there. Shares have low, medium risk over the longer investment period. So when we look at shares, we'll discuss the portion of risk there and why it is over the longer period. Shares with higher risk have a greater potential for higher returns. Okay, and then we'll go into ordinary and preference shares a little bit later.
Mr. Edwards, I've got a question for you. I've got a Standard Bank savings account, and they guarantee me that I will always get my money back. Now, why would I take money, if it's so available to me to actually invest my money into a Standard Bank savings account? Why wouldn't I just always do that? And why would I take a risk if you say shares have a low or medium risk? If I've got no risk to take for a savings account, why would I do that?
Okay, so when you're looking at investments, many occasions you might have heard the term high risk, high return. Okay, so if you're willing to take that risk, there's a potential that you might actually get a greater return. Okay, but unfortunately, there's also the risk that you might lose your money. So if you have that situation, it comes back to your personal budget and your personal approach to investments. You might be willing to take that risk. So if we compare, maybe I'll ask a question back to you. If you're an older person and you've got money to invest, or you're a younger person and you've got money to invest, as an older person, would you be willing to invest in higher risk investments?
Well, I don't think I would be, because I'm close to retirement and I cannot risk the money that I would need in order to take me through my older years when I cannot earn an income. I would not be wanting to be dependent on my children, so I would rather protect that investment. So I would not like to take a risk. But if I'm a younger person, I would guess there's more time to make up any short-term losses, and then I can actually get a higher return on my investment than just putting it into a savings account then.
Yeah. So grade 12, again, it comes down to your personal circumstance and your personal willingness to maybe take that risk on. Okay, so let's get back to the slides over here. So the next thing that we talk about is investment period. How long are you going to be investing your money for? Okay, so the longer you're willing to invest your money, okay, meaning that you don't necessarily have access to that money. So, for example, a fixed deposit, you can actually have a fixed deposit for 5 years. And often banking institutions will be more inclined to give you a greater interest because you are willing to invest for that longer period of time. All right, so let's have a look here. This refers to the duration of the investment, which may influence the return on that investment. The investment period can be short, medium, or long-term, depending on the investor needs. And again, coming back to the needs and circumstances of that investor. All right, so grade 12s, you are possibly saving for your studies, okay, and you may be needing that money in 6 months' time in order to pay for that, your studies, for that student or the university fees. So therefore, that's going to decide as to which investment period you are willing to go for. So it would be a maximum of maybe 6 months, whereas as a grade 8, for example, if they are willing to invest money for their studies, okay, they might be able to put money away for a 5-year period. So again, it comes down to your personal needs and circumstances.
Well, Mr. Edwards, it's actually quite interesting to me that the younger you are, the better possibility you have to get greater potential growth, I think, for the future. So it's maybe a good idea for young people like this. Some of them will enter the world of work next year already, to start putting away money into investment portfolios as young as possible.
Sure. And Guz, I mean, you've heard of the difference between compound interest and simple interest. The longer you invest your money, the greater your return, because it's interest on interest. Okay, so that's exactly what Dion's just referring to. The longer you're investing, and that's why we will always encourage our learners to start investing as early as possible. Start saving for your future or your future needs as early as possible. Okay. So the next thing that we're going to be having a look at on the slides is inflation rates. Now, why do you think, Dion, inflation rates is important when looking at an investment and the decision that you're going to make?
Right. I would guess that your inflation rate is the buying power of your currency. So with other words, I always use the example, if it was 20 years ago, 20 Rand could have bought you a whole basket full of goods. But that same 20 Rand today can buy you a Coke and an ice cream, if you're lucky. Now, the thing is, if I've just taken, and I'm guessing here, taken my 20 Rand and put it under the cushion, in 20 years' time, I still have my 20 Rand. I've taken no risk. But that 20 Rand cannot buy me the same things as what it could have been a couple of years ago. So I would guess that a saving or any investment needs to grow at least higher than the rate of inflation, so I don't lose on the buying power of my currency.
Yeah, so the inflation rate, guys, just as a reminder, is the rate at which your prices of general products increase. Okay, so if we're saying that your inflation rate is increasing by, say, 4% per year, okay, you would need to make sure that your investments is actually returning at least 4%. Otherwise, you're actually not gaining money in the long term. Okay, so if we go back to the previous slide there, okay, personal budget. Okay, this is the next factor that we need to take into account. Investors can determine the amount of surplus money that can be invested. Right. So again, it comes down to your personal budget, how much money you've got available to invest at the end of the month or at the beginning of the month, whenever you decide to invest your money. Okay. The next thing that we need to look at is liquidity. Now, this is a term that might be new to you. Okay, it is all about the ability for your assets to be turned into cash. How quickly can this be done? So the question I always ask my learners is, if you're looking at a property, if you own a house, is that a liquid asset or is it a non-liquid asset? Dion?
I would guess a house would be not so liquid. The reason is, if I take the definition there and I measure it, the definition says then it must be easily turned into cash. The moment that I sell a property, I need to have it registered. It will take a couple of months in order to do so. I need to get a person that's willing to buy the property. That may take a couple of months. So the first time that you're going to really see your money is only in 6 months' time. So therefore, although the asset is there, I wouldn't say that it's liquid, because it's going to take me 6 months in order to get my money before I can have the cash available to reinvest into something else.
Perfect. So that would be an asset that's not necessarily liquid. Now we look at something like cash in the bank. That's something that you can literally transfer across to a third party straight away, easily. So that would be a liquid asset, okay, because it can be turned into cash quickly. All right. So that is liquidity. An amount could be invested in a type of investment that can easily be converted to cash. So remember that example that I had of a fixed deposit that you put away for 5 years. You don't have access to that. So that means that that fixed deposit is not a liquid asset, okay, because you do not have access to that money. Okay. The next thing that we're going to have a look at, the last factor that we need to take into account, is taxation. Okay, a good investment will yield good after-tax returns. Okay, income tax implications must be considered in order to ensure a high net after-tax return. Now, remember, the government wants to have access to a portion of your income, and a return on an investment is a form of income. So you will get charged tax on that. So after taxation takes place, you want to make sure that you are getting a significant return on that investment. Now, bear in mind, there's also tax-free savings accounts. There's also different types of investment products that have different tax characteristics. So also the government gives you access to a tax-free savings account, for example, whereby you can invest 36,000 Rand per year, and that 36,000 Rand will never be taxed, or the return on that 36,000 Rand will never be taxed. So it's something to take advantage of when you start investing. All right.
So with other words, Mr. Edwards, I can put in my money into a thing that gives me a very high rate of return, but that's gross. With other words, not taking into consideration tax. And then I would choose it above another investment, for example, a savings account, and then I say, but hang on a second, after they've taken into consideration tax, my return on the other account would have been better, because what I get after the tax might be better. Although this one had a higher rate of return, not considering the tax.
Exactly. So you've got to keep that in mind when deciding what investment products you are going to be choosing. All right. So the next thing that we're going to be looking at, taking into account some of the factors that we have spoken about now, we now need to look at types of investments. Right. So using those factors, we now use those to choose what investment we're going to look at. Okay, so a few things that we're going to be discussing: unit trusts, managed portfolios, shares, debentures, retail savings bonds. There's numerous examples of the types of investments that you can choose from. These all have their characteristics which would be appropriate to your circumstance and your needs. Right, so let's have a look firstly at unit trusts. Okay. As a definition, a unit trust is a collection of investment options, methods made up of shares in different companies. Now, the terminology, you don't put all your, or the phrase, you don't put all your eggs in one basket comes to mind here. Because if you're putting all your money into one company as an investor, okay, you're putting all your eggs in one basket and you might run the risk of no return or a loss. Whereas here in a unit trust, you are actually diversifying. Okay, so you're going into different companies, investing in different forms of products, and thereby you are spreading your risk, okay, into a portfolio. One of the nice things about this unit trust is that it's also managed by a fund or portfolio manager. And obviously, because that person is managing that portfolio, they are considered experts, and they will identify different things that have that play a role in whether you get a return on that money. Can be bought directly from an accredited service provider. So you can literally go to an FNB and they will have unit trusts that you can invest in. The point here is that you're diversifying your risk.
Mr. Edwards, I've got a question. Let's say I've got 500 Rand a month. Why can't I just buy my own shares? Why would it be something to consider putting my money into a unit trust, for example?
Okay, I just want to bring your attention to the second bullet there. So the second bullet saying that it is invested by or managed by a fund manager. Okay, so that person is an expert in the market. He knows what's going on. He or she knows what's going on in that market. Unfortunately, they don't do it for free. So
No.
they're going to take a commission. So they'll take a portion of your return. Okay, but they should, because they're an expert, have knowledge and expertise that will hopefully enable you to get a greater return.
Okay. I've also noticed there, the second bullet point says the investments of a number of investors are pooled. Now, that is a very important concept, because if you take 500 Rand, for example, if one share costs, well, I don't know, if it's one of these big listed companies, it can be 1,000 or more Rand per share in one of those companies. So that means I'm already excluded. I cannot put my 500 Rand towards that share because it's not within my range. But if a number of people and thousands of people pool their money together into one fund, now the fund manager has got billions of rands to diversify and buy any share that he would like to buy from that pool. And everybody that pools their money together will then get the same benefit from the diversification into multiple different companies than to doing it on your own.
Yeah, sure. So the more money you have, the more return that you will gain. All right, so that's the benefit of a unit trust. The next slide just illustrates more what a unit trust is all about. So on the left-hand side there, you've got the money is pooled from investors, as Dion has just referred to. The fund manager invests money according to the fund objective or benchmark, depending on what type of unit trust it is. And then lastly, the shares from different industries, bonds, these are the types of things that they will invest in, hybrid instruments, convertibles, or derivatives. So we're not going to go into those specific details or characteristics there, but just to know that your fund manager is the one in charge in what they're going to be investing in and hopefully getting you a nice return on your money. Okay. Unfortunately, there is a risk involved with unit trusts. So investment may be made in high and low risk shares, which spread the risk throughout the fund and lowers the risk for all the investors. All right, so again, coming down to spreading that risk across different types of products, investment portfolios. Fund managers are able to manage the risk level of the fund on behalf of the investor. So again, they have those expertise to be able to decide which is the best portfolio to invest in. Okay, we are now just going to have a look at a managed portfolio. Okay, a managed portfolio, very similar concept to your unit trust. An investor instructs a financial institution to manage his or her various investment assets in one portfolio. And remember, when we're referring to a portfolio, it's meaning that there's a portfolio of diverse shares within that portfolio of investments. Okay, so it's not just one share that you are investing in, you're investing in several different types of shares. Okay, if the portfolio does not perform well, the portfolio thereof may be changed with or without informing the investor, because the managed portfolio is, or it's managed by an expert, and you give the permission as the investor for that manager of that portfolio to actually make that decision on your behalf. Okay, some of the risks involved here. Okay, first and foremost, it is lower because it is over a longer term. Now remember that, guys, when we're going through these different types of investments, the term also has a major effect on whether there is a risk involved. The shorter the term, the more risk involved. Okay, investments are made in various sectors. Again, if there is a situation, maybe the mining sector, there's a great deal of strike action taking place, your mining shares might decrease in value. But because a managed portfolio is spreading the risk across different sectors, then that risk is minimized. Okay, the last one there, money is usually invested in the capital market, and unforeseen circumstances may impact negatively on the value of the portfolio on the short term. Again, looking at the example of strike action on the mining sector, that is over the short term. But if you're looking over a 5-year period, maybe you will be getting that significant return over that 5-year period. All right. The next thing we have a look at is shares. Okay, shares are quite a significant section of the investment section of work, and no doubt you'll be getting a question about shares in your coming exams. Okay, Dion, what is your take on shares? What would you say a share is?
Well, I would say that a share, it actually lies in the word. You share in the profit of a company, and the only way that you can share in the profit of a company is if you are part of the owners. So you also own a share, a portion of a specific company.
Okay, so yeah, I mean, you can look at it as a pie chart, for example. You own a share, a part of that company. Okay, and with that, hopefully you will benefit from the returns within the profit of that company. Okay, so let's have a look as to the definition of what a share is. Okay, companies issue portions of its ownership to shareholders in the form of shares on the open market to obtain capital to operate its core business. So the example that I always tell my grade 12s is a number of years ago, Mark Zuckerberg, he floated the company Facebook. Okay, when they talk about floated a company, it means that they went onto the open market. They became a public company. So he made a certain portion of his company available to the public. The reason being that he wanted to buy out some other companies. So hence the reason why you've got the likes of WhatsApp, Instagram, and other types of companies that are now owned by Facebook. Okay, because he was able to obtain a great deal of capital, which enabled him to therefore buy out those companies. Okay, they paid several $1 billion for those companies. All right, so that is why a company or an individual like Mark Zuckerberg would be willing to forego some of his company, a portion of his company, to the public. Okay, shares give the holder 1 vote per share. Okay, and the right to receive a dividend, as we mentioned. Okay, a dividend being the portion of the profit. Shares of listed companies are traded on the JSE. All right, the JSE is a Johannesburg Stock Exchange. Okay, that is where you are able to buy and sell shares. All right, so that's something to keep in mind. We'll talk about the functions of the JSE a little bit later. Okay, as mentioned there, the next bullet, shares can be bought and sold through stock or share brokers, to whom a brokerage fee will be paid to the investor or by the investor. And stockbrokers are available, and they should be professionals or experts in their field of work, but you're able to invest on your own these days. Okay, so you can go and use a platform online, and you'll be able to buy and sell your shares. Okay, so just keep in mind the other bullets there. And as we often say, Mr. Van Zyl mentioned earlier, that there's no need to necessarily remember all of those points. Okay, maximum of 4 should be sufficient.
Mr. Edwards, I'm interested to know, in a share, is the shareholder always entitled to receive a dividend? Like if I put my money, for instance, in the bank guarantees me that they will pay me interest. Is that necessarily the case with a share?
Not necessarily, and again, that's the risk that you take. Okay, so if a company does not make a profit for that year, then unfortunately you're not going to gain any return, any dividend on that investment that you made. Also, if they have made a profit and they've decided, like a company, Amazon, that you have possibly come across before, they're not necessarily to provide dividends. Okay, but people are investing into Amazon because they're seeing their investment grow over a longer period of time. Okay, so what happens to that profit? It gets reinvested back into the company. So they might be looking to buy out another firm. They might be willing to, or looking at different countries, putting branches in different countries, particularly Cape Town. A lot of Amazon, they're employing a great deal of employees in Cape Town, and that needs capital in order to do that.
So that's quite interesting. So with other words, they don't make necessarily a return on investment in the form of a dividend, which is an income-bearing thing. They make their return on investment in selling your shares by the time that you want to sell it for more than what it's worth. So with other words, shares can give you 2 types of return of investment. They can
Correct.
give you an income, or they can give you a return on investment in the form of a capital gain.
Yeah,
so that's actually a very, very interesting, and I like the Amazon example, especially for that. Not known to pay dividends, so you're not going to get an income from it, but I will probably make more money when I sell my Amazon investment by the time that I want to turn it into cash.
That's it. So, for example, if you've invested 1,000 Rand, you've bought one share at a particular company, you've invested 1,000 Rand for that share, and 20 years down the line, that company's done incredibly well, and you look back at that investment and it's now worth 20,000 Rand. So you've actually made a great deal of capital gain on that investment.
And that's also another question that I would like to ask on a share. How liquid is my investment in shares?
Well, you can go on to, as we've mentioned over there, you can go to the Johannesburg Stock Exchange and sell your shares. So it would be considered quite a liquid investment.
So I'll get my money almost immediately?
For sure. So you can use different platforms to buy and sell shares, and within maybe as little as a couple of hours, you might have your money in cash. Okay. So now, one of the things that you need to take into account with shares is that there is a risk involved. Okay, so let's have a look at the risks associated with shares. All right, so the shares are low to medium risk over the long term. All right, so the reason why we've got that graph over there is to illustrate exactly that. Okay, so that is looking at an investment over a period from 2011 or so all the way through to maybe 2017. All right, so you can see the general trend is upward sloping. So over the long term, the risk is rather low. But then let's look at the period of mid-2015 to 2017, okay, or mid-2016. There's a lot of activity going on there, up and down, up and down. So over the short period, okay, that's about a year, it's quite volatile. There's lots of changes taking place, meaning that there's a risk involved. So yes, you might gain a great deal of return, but you could also lose your money, right? And that's where the risk comes in. the potential to lose your initial investment. Okay, so ordinary shares have the highest risk, as the investor may lose the full or part of the investment. And one of the types of companies that comes to mind is Steinhoff. Okay, if you invested in Steinhoff a number of years ago, you would have seen an upward trend. But then within a couple of days, a week or two, that investment had dropped significantly, and people lost a great deal of money when that investment dropped. Okay, so that's an example of how a share can be a risk over the short term.
And that's also maybe a very good example to use to say, if I put all my money into one company, something like that is bound to happen.
Sure.
Because you see what happened at the Steinhoff thing is very important. The investors started losing its appetite for Steinhoff because it became known that they were involved in all sorts of shady activity, and people started withdrawing their money, and the share price dropped so significantly that you almost lost everything.
Sure.
So that is, but if you would have diversified your portfolio to say, I've got Steinhoff, but I've also got other shares that have done well, then I'm losing in the one, but the other ones make up for the loss that I've made here.
That's it. All right. So the next thing is preference shareholders. Okay, risk is lower as they have preferential claims on the assets of the liquidated company. All right. So this is the first time that you're seeing an ordinary share and a preference share. Okay. The difference being that the preference shareholder gets his or her return before the ordinary shareholders, and they will therefore get more a guaranteed return on that investment. All right, so there's different reasons as to why someone would invest as a preference share as opposed to an ordinary share. Okay, I'm going to move on to debentures. Okay, debentures. What is a debenture? It is issued to raise borrowed capital from the public. All right, so that is the lender holder, okay, the debenture holder agrees to lend money to a company on certain conditions for a certain period. Right. So it's funny that we mention investments and lending money in the same sentence. Okay, so that's exactly what a debenture is. You've got people that lend money, and the return, the interest that is gained from that is the reason why people will be willing to lend that money. Okay, so debenture is one aspect or one type of investment. Okay, the risks associated with the debenture. Debentures have low risk as they need to be paid back. Okay, that should be back there. And companies are liable to repay the amount of the debenture plus interest, which decrease the risk for the investor. So again, your initial investment is guaranteed, and you know that you're going to be getting a return on that investment in the form of interest. So again, it comes down to the characteristics and the risks associated with those characteristics.
So, Mr. Edwards, you are basically still, with both a share and a debenture, investing in a company. Am I correct? But in the one, I'm actually just buying a share of ownership. So I'm part of this company. I'm owning part of it.
That's it.
But with a debenture, what is the difference then?
Well, look, there's no ownership there. Okay, so it's only it's an agreement between yourself and the company that an amount will be borrowed, and there would be an interest paid on that amount. Just like you go to the bank and you get a loan, you pay an interest back on that loan.
And instead of for the company going to the bank, they're just borrowing money from me.
Correct.
And they pay me an interest on it. So with other words, whether the company makes a profit or not, they still need to pay me that year.
Correct. So that's where the risk factor comes into play.
So therefore it is lower risk.
Correct. Okay, so that is a debenture. Okay, we're now going to look at an RSA retail savings bond. Now, the reason why it's got RSA is because they are issued by the National Treasury in South Africa. Okay, so Republic of South Africa Retail Savings Bond. So let's have a look at what that is. To encourage saving, the SA government offers SA citizens the opportunity to invest in savings bonds. Okay, it is also a method in which the government can gain capital as well. So they can issue those government savings bonds with the guarantee that they are going to pay back with interest. Okay, so you might invest for 6 months, you might invest for a year. Okay, you get your initial investment of say 1,000 rand plus the interest that was agreed upon right at the beginning.
So basically, I'm borrowing money to South African government.
Correct.
Okay.
Okay, so again, it comes down to the risk because the risk is lower because you know what's going to happen at the end of that investment and you know your initial capital is guaranteed.
Mr. Edwards, if you can just quickly go back to the previous, I've just read something there. The 1, 2, 3, fourth bullet says it cannot be used as security to obtain a loan. Now, I'm not completely sure what that security means.
Okay, so security, guys, if you're wanting to buy a house, for example, and you don't, the bank's also taking a risk on loaning you that, say, 2 million rand, that home loan. Okay, so what they will do is they will ask, well, do you have anything that you can put down as security so that if you cannot pay back your repayments on a monthly basis, we can gain access to that. So maybe you've got a fancy car, you've got another property, another house that they can access in order to make sure that they're getting their money back.
So if I don't pay, they're going to sell those things for me to cover the loan. But now it says there, it cannot be used as security to obtain a loan. So this is just quite interesting to me. So that means if I go and make debt and they want security, I can say to them, I've got a car or a house or whatever, I put up a security. But the one thing that I cannot do is I cannot give them the retail savings bond. It cannot be used as security for the loan.
Correct. Okay. So there are risks associated with RSA bonds, but they are very low. Okay. As an investment is made with the government, who cannot disappear or go bankrupt, okay? It is a safe investment as it cannot be sold on the open market and it's not exposed to market risks, okay? Again, it comes down to that agreed terms with regards to your interest at the beginning when you made the initial investment. Okay, fixed property. Okay, now we're looking at different types of properties like a home or you wanting to buy a flat. These are investments. Why are they investments, Dion?
Fixed property. Fixed property has proven over time that it always appreciates. It can have to do with something like scarcity value of properties. It could be that many people want to live in a specific area and the property therefore has more people that want to buy it, and because of the price theory, then the property value goes up. And over time, property has always showed that it always appreciates in value, never depreciates.
Okay, so yeah, if we look at the definition on the slides, buying a house, a piece of land, for example, is usually suitable as a long-term investment only. So you'll hear stories of people getting great deal of return on an investment over a long period. Okay, maybe your parents have bought a house years ago for 50,000 rand and now it's worth 1.5 million rand. That's a great deal of return on an initial investment. So hence the reason why this can be quite a good investment opportunity. Unfortunately, there are large fees involved, okay, and also you will have to pay capital gains tax potentially if you gain a great deal of return on this investment. Okay, and because it's a longer term, there is a lower risk, okay, because you might see a general trend of an increase in value, but over the short term, you might see more volatile changes happening. Okay, so risk may be determined by economic conditions and may influence the value of the property. Okay, so if you go back to 2008, 2009, the economic crisis, that was all about the property sector. And we did see occurrences where the value of property decreased and unfortunately people did lose money. But that was only over the short term. It has gained over the last couple of years as well.
Mr. Edwards, maybe a nice question. What is your thoughts on the impact of COVID, for example, on property prices in South Africa currently?
Okay, so something to consider is whether the houses are being sold at the moment. Are they being sold? Is the demand high? Now, you'll remember in grade 9 EMS, we spoke about something called demand and supply. If there's a high demand for something, people are going to be willing to pay. So hence the reason the price will now increase. Unfortunately, over this COVID-19 coronavirus period, people are not necessarily looking at buying property. So hence, the property prices might
Decrease or stabilize for that matter, and you will not see a return on investment, which you have bought a property right now. But we know historically that over a period of time, let's say 5 years from now or 10 years from now, your property value might have increased again. It's the short-term economic conditions currently that we are experiencing that might have an effect that your property prices would not have increased if you have bought now.
Yeah, so some people that were maybe looking at selling property now, okay, last year they might have thought, okay, I'm going to sell my property next year. They might think twice now because they're going to wait for the property prices maybe to increase at a later stage.
Maybe it's a good idea to buy property now.
That's it. Okay, because you're getting them at a low price and you might see a return on that money later. Okay, now we're looking at mutual funds and stokvels. Now, some of you might have come across a stokvel recently. Okay, there's occurrences of a WhatsApp stokvel going around where a number of people put in money, and you can see the illustration on your screen now where they're looking at different groups putting money in, and then at some point one person gets a payout from that group. Okay, so that's essentially what a stokvel is. It's a mutual fund where you're getting a group of people together, and remember what we said earlier, the more money you've got, the more potential that you may get a return. Okay, so let's have a look what a mutual fund is. It is an informal savings scheme to which a relatively small group of people contribute, and the more people contribute, the greater possible returns. Each member takes a turn to draw from the scheme for their own personal gain. Okay, so you might invest 250 Rand and you have 4 people that have invested, and at some point in time you're going to get the 1,000 Rand that paid out. Okay.
Mr. Edwards, maybe this is an interesting one. There was at our school a stokvel for around teachers. The idea was not really to make a return on investment. It's just a fixed way of putting your money, and then every month a different person will get all the money. So everybody puts in 250 Rand, and then in month 2, these people will get, and in month 3. So they didn't really make a return on the investment, but they just take turns of actually getting something back. It's just a forced savings plan.
Correct.
But it's not really meant to give you really a return. It's just an informal way. And therein lies the problem with the WhatsApp group things, because that is where pyramid schemes start.
Correct.
Where I want to try and make an investment without actually investing in something concrete, like people, companies that buy and sell things or manufacture things. You're actually investing money into nothing. And if they offer you return on investment, then that's where the red light should go on, that it's actually a pyramid scheme, which is something different.
And also when you've got one person in charge of the management of that stokvel as well, then you also got to ensure that that person is trustworthy. All right, so as mentioned, there are some risks involved with stokvels. Schemers who claim to be running a stokvel may actually be running illegal pyramid schemes, as Dion has just referred to. Money in a savings account is a safe investment, but with low interest rates. So this is if you're using a stokvel at a banking institution, for example. Okay. Now, venture capital. Okay, venture capital, you'll see there in the image Dragon's Den. Okay, there's an equivalent type of show in South Africa called Shark Tank. And what it is the people with money are willing to invest in people that maybe don't have as much capital available to them, but they need some assistance. Okay, there will be certain characteristics or agreed terms, though, because you would be giving up some part of your company. Let's have a look at the definition there. Venture capital is given by an investor, okay, to start up a business in return to have a share in the new expanded business. And because they've got that share, they are hoping that they are going to get a return through capital gains, through growth, or maybe via dividends. Okay, so that's venture capital, and there are risks involved here. Okay, high risk for the investor if research is not properly done. All right, so because the investment might be in a company that's maybe doesn't have a very long track record, and there's that initial investment risk because you might lose part of your capital that you've invested in that company. Inexperienced business owners that make wrong business decisions may experience big losses. Okay, so that's venture capital. Now we look at endowment policies, life insurance policies, and retirement annuities. Okay, these will be discussed in your insurance section as well. Okay, let's have a look at as to what these are. A monthly payment is paid to an insurance company, for example, your Momentum or Liberty, as we had an image on the previous slide. Okay, this is an insurance company with the expectancy of receiving a predetermined amount on a date in the future. So a lot of these are done in order to ensure that you are covered in later life. So as a retirement package, or for example, life insurance. I'm going to ask the professional here, what is life insurance?
Life insurance is when you invest in something that is most certain, and for many of you this might be a shock, but people are known to die at some point in time in their life. The life will come to an end. Now, when you invest in a life insurance policy, you invest in something that will most definitely happen, and when that event happens, it will pay you a predetermined amount of money that you have agreed with the insurance company. Now, the only thing there is it's uncertain when people are going to die. So some people live longer than others, and those that live longer subsidizes those that die sooner. And that is how it basically works.
Okay, so they are relatively low risk. If we look at the slide, they're low risk as the insured amount will be paid out regardless of the circumstances. Okay, so if on your death, for example, then it is guaranteed that your beneficiaries will be paid out. Or a retirement annuity at the age of 55, those will be paid out to you in a lump sum, and then thereafter you could possibly have that in a policy where it pays out on a monthly basis to you. Okay, so let's have a look at the fixed deposit as an example of a relatively low risk investment. Okay, so you can go to any one of your banking institutions and you can get a fixed deposit, right? It is a very conservative method of investment at a fixed rate for a fixed period, and you'll find very often your pensioners will look at this option because you can have your interest paid out at the end of the period. If it's a 5-year period, you get your interest paid out, and remember it's compounded. Or you could have it as an investment where it pays out on a monthly basis. So that could be replacing your salary, for example. All right. So the money cannot be withdrawn. So that's one of the downsides. Cannot be withdrawn during the period, and that means that you've got to consider when you are going to need this money. Okay, so let's have a look at the risks associated with a fixed deposit. Very low, as the investor will receive what was promised. Okay, so right at the beginning of the investment, you know what you're going to be getting as a return. 32-day notice deposits. Now, the word notice is important to take note of. Okay, money is invested at a fixed rate, so very similar to your fixed deposit, although withdrawals can be made. But unfortunately, you've got to give notice to your bank. Okay, and that is 32 days, for example. You need your money in a month's time. You need to make sure that you've contacted your banking institution and you've said, I need access to 1,000 Rand of my 32-day notice. Okay.
Mr. Edwards, just so by the by, let's say I'm a young man that just started university. I've been paid a bit of money, but I'm known to party hard, right? Why is it a good idea for me to put my money into a 32-day notice deposit?
As opposed to just having it in your savings account.
As opposed to having it in my savings account, yes.
Okay, because you don't have access to this. You don't have. It's not a very liquid asset if we refer to that terminology before. Okay, you need to give notice to that bank that you're wanting access to that money, and you're only wanting access 32 days time. Okay,
so to pay books and things like that,
sure.
And you know a month in advance that I would need to pay, and then I will make that money loose.
Yep.
So I cannot use it in the spur of the moment tonight.
At 3 o'clock in the morning.
At 3 o'clock in the morning, for instance. And then, of course, because there's 32-day notice, the interest rate is a lot higher than just in your savings account or something like that.
Correct. Okay, so that's a 32-day notice. If we look at the risks involved here, it's a low risk. Okay, because you know what you're going to be getting, okay, and also you don't necessarily have access to it straight away. Okay, so the investment plus interest will be paid out on the maturity of the date of investment. Okay, so that's something to keep in mind. Okay, if we look at the types of shares. Now, we'll just go through this rather quickly as we are running rather low of time. So if we're looking at types of shares, firstly, ordinary shares, which we spoke about earlier. Okay, ordinary shares only receive dividends when profit is made. Also, only if the company actually declares a profit. All right, as we spoke about with Dion earlier. Okay, the rights of ordinary shareholders: vote at the annual general meeting, attend AGMs to learn about the company's performance, receive interim and annual reports. Okay, so these are the rights of ordinary shareholders. Preference shares, on the other hand, okay, some of these types of shares receive dividends regardless of whether profit is made. So it's more guaranteed. There's a lower risk. You might not get access or as much return, okay, but it is guaranteed that you're going to get some sort of return from the investment that you've made. A fixed rate of return is paid on this type of share. Okay, shareholders have a preferred claim on the company assets in the event of bankruptcy or liquidation. So if the business closes down and all the assets are liquidated, okay, meaning they're sold off, you are guaranteed, or not necessarily guaranteed, but you are preferred over an ordinary shareholder to get a payout. Okay, so the rights of preferential shareholders receive dividends regardless of how much profits are made. It's a fixed rate of return. They are paid first and enjoy preferential rights to those dividends, and also they can claim if a company is liquidated. Okay. The third type of share is a founder's share, issued to the founders and incorporators of the company. So those individuals that start a business, they receive dividends after all other shareholders were paid.
Like Mark Zuckerberg, for example.
Correct. So some of those guys that started the businesses right at the beginning, and they're not necessarily there for dividends. They're there to grow with the business. So they're wanting to maybe sell those shares in 5-10 years' time and make a considerable return on those shares. Okay. The last share that we're going to be looking at is bonus shares. So gifts, payments in the form of shares to shareholders. So maybe a company has not made any profits. So they go to their shareholders and say, well, look, we haven't made a profit, so we can't pay out dividends. But what we are going to do, we're going to give you more shares now, and hopefully you'll get a return on a later stage. Issued as a compensation for unpaid dividends, as I've just mentioned. Also, bonus shares often are given to employees. Okay, rather than giving them income or salary, they will gain access to a bonus share.
Like a fringe benefit, for
Correct.
example. There's also something else. Those unpaid dividends. Guys, sometimes a business did make a profit for this year, but the company's management decided that they are not going to declare a dividend. That means they're not going to divide the profit up. What they're going to do is they're going to keep it because I now want to expand. Let's say in the case of Facebook that wants to buy WhatsApp. I'm going to keep my profits and I'm going to use it in order to expand so that the business is now worth more and hopefully my shares will increase. Now, in order for us to compensate my shareholder for not paying them the dividends because I used my profits for something else, then the next year I will issue them, or that same year we say, listen, we have had a new opportunity that will actually increase in value. So there's bonus shares for you to compensate you for the fact that we are not going to give you cash.
Okay. All right, so Grade 12s, we have come to the end of our broadcast for today. There are a number of other shares that will be made, slides that will be made available to you. Please make sure that you go through them and ask your teacher for some advice or some further information with regards to this. But for today, it's been an absolute pleasure to be joining you in today's broadcast, and wishing you all the very best for the coming exams, your preliminary exams and the finals, and stay safe and keep warm.
Thank you very much from my side as well, and to you, Mr. Peter Edwards, for having us this afternoon. Guys, just from my side, I think the full presentation in terms of the PowerPoint presentation should be on the WCDE portal very soon. So you will get this along with your booklet, and you can go through it and fill in all the stuff that you had to do for the booklet. And please be in contact with your teacher to explain certain concepts to you that we couldn't get to today or through this presentation. And I'm sure you should get some good help. And guys, the core content, very important. You actually only need that to study if you're from the Western Cape, and I can assure you, guys, going through old question papers with your core content is probably the best way to prepare for your exams coming up. So from my side, thank you very much for this opportunity, and I hope you guys will stay safe and that you guys do very well in the upcoming exams.
Cheers for now.